Thanks, guys, for tuning in. We are in the April month of our SIH Capital Group monthly webinar series. I'm really happy to have Joseph on. I met Joseph about, I would say, 4 or 5 months ago. He spoke at a local RIA that I'm a part of. His presentation right away was something I was fairly interested in. It was a topic that a lot of real estate investors come across. It's basically the infinite banking concept, but Joe had a different way of doing it, and that's why I wanted to bring him on here to go over his approach. You'll definitely see some similarities, but there's some interesting differences that I thought would make it worthwhile to present to my group. So, Joe, I will pass it on to you. Why don't you give a little bit of background on yourself, what you do these days, and then we'll get into any other topics we want to discuss today.
Terrific. Dennis, thanks for having me. I'm glad to have the opportunity to speak with you and some of your guests here today. As we had spoken about in the past, my career started working on Wall Street back in 1998. What I quickly learned in working on Wall Street is that when your financial future is based on projections and hypotheticals and purely the stock market, your future ultimately is projections, hypotheticals, and what ifs. So I really began to shift my career maybe 15 years ago. And the way I did that was by studying how wealthy people make financial decisions. And what I learned through that process is how the financial institutions and the government really program us how they want us to think a lot of ways about money. They program us with regard to financial products that we have and financial strategies that we have. And as a layman, it becomes quite confusing. So what I do in my day job is I work with individuals and show them how wealthy people make financial decisions and share with them some of the strategies that they find success in, because we believe that success leaves clues, and we can share some of those clues. So I think some of the things that we'll chat about tonight, like we've spoken about in the past, is some of those financial strategies that we help individuals with.
Nice. Joe, do you want to, I think you have the ability to share screen if you want to get into your presentation, and then we'll take any questions if some come across.
Sure. Yeah, that sounds great. So I think one of the things that we'll talk through here this evening is the velocity of money, specifically around life insurance and earning multiple rates of return on a dollar. And to much of your audience, similar to how I operate, is utilizing the velocity of money, specifically with how it relates to real estate. Okay. Can you see my screen, Dennis?
Yep, you're good.
Great. The financial institutions typically want us to relinquish control of our money for long periods of time, let it sit idle, and earn a rate of return. And as a result of that, what we realize is that the banks ultimately could more frequently, or the financial institutions more frequently, get multiple uses of a dollar. So when we look at how banks make money much differently than the way individuals are told to make money, we're told to put a dollar, let the dollar sit, let the dollar grow. Yet banks make money through fractional reserve lending, or as we call it, the velocity of money. So if we have a dollar on deposit, the bank's taking that money and lending it back out to someone on a mortgage, and that person's paying their mortgage payment, and they're taking that dollar and lending it back out to someone to finance a car or through credit card purchases. Through the fractional reserve system, banks have the ability to lend money 10 to 1 for what we have on deposits. So while they're telling us to lock our money up and let it sit for long periods of time, they're creating wealth for the financial institution by recirculating that dollar multiple times and earning multiple rates of return on that dollar. Okay. When we talk about having money grow efficiently and effectively, we like to talk through concepts and talk through different ways where clients could earn multiple rates of return on dollars. Now, as Dennis, I don't sell real estate. I'm not in the investment business. These are just conceptual conversations around how money works and how to build protection around a financial strategy. But real estate is a good example, as I know you and your audience is very engaged in, on how you can begin to earn multiple rates of return on a dollar. We're often told that in order to earn a higher return, we need to take more risk. And in order to get that, if we take that risk, we could earn more reward. Yet if you look at how wealthy people invest into real estate, their objective is not to take an abundance of risk to earn a rate of return. And when you buy a piece of real estate, if you wanted to earn a 20% rate of return, the goal wouldn't be to buy the most aggressive or speculative piece of real estate and hope that appreciates in value. Yet, you could buy a moderate piece of real estate that the numbers make sense, and you could earn a small return multiple times on that dollar. So for example, We buy a piece of property, and over time, that land will appreciate in value. We can anticipate that land appreciating since inception. I think they say real estate appreciates at around 5% per year. Okay. In addition to that 5% return, so while that property is increasing in value, we're also receiving some tax advantages. And this changes obviously with the tax code year by year. Currently, there's some real advantageous tax benefits, specifically to depreciation and cost segregation studies therein. But the structure of that building has a schedule that the IRS allows you to write down against income on that property. That depreciation is a measurable return. And if we call that a 5% return, where that helps is on that rental income. So the rental income is the net cash flow, which is the gross income minus the operating expenses of that property, which is what the investor puts in their pocket. And if that was, say, 5% of what the down payment was, that might not have a taxable event if there's depreciation on the property that could potentially wipe out that income, thereby adding an additional rate of return, a phantom type of a return. And then lastly, you have a mortgage, and a mortgage earns almost multiple returns within and of itself, thereby earning leverage on a down payment. So you're putting down, let's say, $100,000 buying a $400,000 property. And as that property increases or appreciates, you're getting the appreciation on the $400,000 number, not the $100,000 number. And in addition to that, that mortgage interest is tax deductible. And unlike a personal tax return for investment real estate, there's no limit on that because it's an expense. So through real estate, you're earning small rates of return multiple times. And it's a great example of the velocity of money and how to earn multiple uses of a dollar. When our clients begin to understand that money is designed to work in motion, not linearly, the way we're told to have it work, we begin to have conversations around different assets that will allow you to get the multiple uses of a dollar or create the velocity of money. And one great place to utilize that is in cash value life insurance. So cash value life insurance, specifically the way we're speaking about it, Dennis, is through whole life insurance. And we want our clients to understand the utilization of whole life insurance. And we think that to simplify it, the easiest way to do that is by understanding, for starters, the different rates of return that exist within a life insurance policy. So like any traditional linear investment, a life insurance policy has an internal rate of return. And by definition, that's focusing on specifically the inner parts or features situated within the limits or surface of something. Okay. So the internal return is dollar for dollar what you're putting in versus what you'll be able to take out of that policy, typically recognized through the cash values of the policy. Now, most investments have one rate of return. You put money in a CD, it's an internal rate of return. You put money into the stock market, it's an internal rate of return. Your real estate could be an internal return. A life insurance policy also has something that's oftentimes not quantified. That's an eternal rate of return. And we call it eternal because it lasts forever. So there's certain benefits inside this policy that may or may not be living benefits, but they will last forever. And then properly structured, the internal return could also be utilized in a multiplier fashion through what we call the external return. And then as the external return is where the magic can happen if you know what you're doing. And it's how the money inside of the life insurance policy could be used outside. So external means derived from a source outside the subject affected. Okay. So once we create, cash flow begins to go into the whole life insurance policy. Whole life insurance contracts, I should start by saying, are primarily purchased for the reason of death benefit. Okay. The main reason you always buy a life insurance policy is death benefit. Now, the internal and the external benefits of that policy are ancillary benefits to what we feel is the biggest benefit of a life insurance policy, which is the death benefit. Now, as we're making deposits into this permanent policy, we're also starting to develop a cash value. That cash value has two elements to it. It has a guaranteed component, which is a contractual guarantee backed by the full faith of the insurance carrier, plus a non-guaranteed benefit, which is comprised of the dividends that we receive from the insurance company. Dividends are not guaranteed. They're determined annually by the board of directors of the insurance companies. And then, as the good insurance companies have paid dividends on their cash value policies for over 100 years. So again, we start to get cash flow into the policy. As the cash flow starts to accumulate over a long period of time, we start to earn dividends on that cash value, which gives us a return on the money that we're depositing into the plan. The next rate of return is the eternal return. And as we mentioned, forever, there'll be a death benefit in place. A lot of the folks that we work with are clients that have accumulated a lot of wealth, either through their business, their real estate assets, or however they might have accumulated it. And that death benefit becomes a tremendous asset, whether it's for estate planning purposes or for purposes of replacing their income should they die prematurely. But that becomes an asset on their balance sheet that they'll own, and the goal is owning that asset forever. One thing business owners love, which a lot of real estate entrepreneurs are, is that the cash value inside of that policy, depending on your state, could have lawsuit or creditor protection, which adds another layer of asset protection, which always seems to be something that's very important to folks who are building assets and creating wealth. Depending on your age and health, there could be disability benefits, which could waive your premiums if in the event that you were ill or sick or long-term disabled and no longer able to fund your policy. And then lastly, one of the additional benefits, I should say, is a long-term care benefit, which a lot of policies now, Dennis, a lot of companies have gotten out of the long-term care business. And we've identified that the most efficient way to utilize that is by having a life insurance policy also have a rider that can provide some long-term care benefits. So these are really important benefits, aside from the cash value, that are very important to understand, that are available through riders through a life insurance policy. And then these life insurance policies, although they're designed through your working years to accumulate cash and maybe help with college or some other thing that might be important to you, they could be used for income streams in the future. One of the biggest risks many folks face in retirement is the risk of outliving money. And when you have a boatload of cash value inside of your policy in retirement years, you could use that money through dividends, through loans, or through annuitizing the policy as a creative structure to create retirement income. Now, as many advantages as we discussed, those are really only two of the main advantages of a life insurance policy. One of the huge benefits of a life insurance policy is there's an additional benefit that we refer to as an external rate of return inside the insurance policy. So let me clarify what that means. Externally, we can use the money that's inside of the cash value as it accumulates and do something different with it. However, it's not going to affect the internal return of the policy, and it may not affect the eternal benefits of the policy, notwithstanding the death benefit. Meaning, if you borrowed money against your policy and there was a loan on it and you passed away, your beneficiaries would receive your death benefit minus the loaned amount on the policy. One of the common misconceptions of how this works is if a life insurance policy is structured properly, your base face amount of insurance should increase over time as your cash value increases. So it's not that your original face amount would be deducted if the properly structured the right way, if the policy is structured the right way when you take a loan against it. Now, here's some of the key things with the external benefits. Number one, you could have access to as much as 95% of your guaranteed cash value as it accumulates. I think that's very important to understand, especially in a time like today when we're dealing with so much adversity in the banking system. When you have a real estate asset, typically, depending on the property, you can have an LTV on that property of somewhere between 60 to 70 to maybe 75%. But that's also based on a subjective appraised value. So how much true equity you can utilize inside of a piece of real estate, as an example, isn't necessarily relative to the type of equity that you have access to inside of your life insurance policy. We've got 95% of cash value available. The way we can access that is through loans. One of the ways we can access it is through loans. Depending on the carrier, some carriers have fixed rate loans that are very attractive in a rising interest rate environment, because it gives you security to be able to borrow money at very reasonable rates for a long period of time. There's no restrictions on the utilization of these funds. So there's no approval process. You don't need to have your credit checked. You don't have to qualify from a credit perspective. And the insurance company doesn't care what you do with the funds inside your policy if you choose to borrow against it. Furthermore, if you take a loan against, the policy continues to earn dividends despite any outstanding loans. So once you take a loan against that policy, you can use the loans to buy real estate. You can use it to send your children to college. You can use it for a business venture. You can use it for whatever you think might make the most sense. Okay. But the reality of it is, I know a lot of your audience is looking at real estate, and life insurance cash values become a terrific sinking fund for a way to be able to accumulate capital to thereby be able to use when you need them the most, which is when you're being able to take advantage of an opportunity. I'll turn it back to you, Dennis. I wanted to give you a broad overview of how money works, the velocity of money, and some of the intricacies without getting too far into the weeds of some of the benefits of cash value life insurance, and open it up to you for any questions or thoughts.
Joseph, first off, thank you. I love it's short, sweet, and gets to the point. I also love the fact that when I talk to many financial advisors, they steer away from real estate, business ventures as potential investments, just because their compensation doesn't align usually with like private securities. So I love the fact that you have a much bigger picture and realize that a portfolio shouldn't just be about your stocks and bonds. And that's where you could get to a policy like this and really unlock the full potential of the policy, because the policy itself is not going to make you rich, right? It's what you do externally. As you brought it up here, it's investing in the business ventures, it's investing in real estate that will create wealth in the long term. So what would you recommend if someone is interested in, and I guess even rewind and say life insurance policies are not even in the picture. If you have an investor and they like their financial advisor, like what would you recommend? How would they approach that financial advisor on getting into some of these alternative assets like real estate or investing in a business or something of that nature?
Dennis, your analysis of the financial landscape oftentimes is true. And there's a couple of things I've learned in my seat in my business. And it's that the individuals who typically have the most success have achieved that success through investments into themselves, whether it's their education, into their business, into things that they control. And I think you're doing a disservice by telling people to not invest into themselves. So what I tell my clients when we begin to work with them is, we are not an investment company. We don't tell you how to invest. We don't teach you how to invest. We teach you how to become really good savers and how to protect the assets that you have from the things in life that we don't have control over. So I think the conversations that you might want to have are conversations around where are places that we can store capital that could be stored in a manner that we don't have to worry about the money not being there when we need it the most. How can we accumulate assets in an uncorrelated bucket that's not tied to the volatility of the stock market, the volatility of even the real estate market, or the volatility of the United States economy? How do we store capital in a manner where we're not going to have erosion from taxes? We're not going to get a 1099 at the end of the year for the interest that we're earning on the funds. And then talk about how you can begin to store capital that will continue to achieve your goals, irrespective of some of the things that you don't have control over. What if there was a lawsuit? What if you're not able to put money into that bucket for 12 months because you're out with a disease or you're sick, if you're injured? Or if, God forbid, tragically something happened to you, how does your family still meet those goals of sending your children to college? And there's not a lot of places to park capital that could achieve many of the things that we just mentioned. Now, the goal is not to put every dollar you have into a life insurance policy, because anything you oversubscribe to could in and of itself fail. But I think it's important to have a bucket of money that achieves some of those things that we mentioned. And I think you have to be open and confident in having a conversation of the people that you work with that understand that protection is, if not one of the key elements of a proper savings plan to accumulate capital.
Got it. And one of the things that I think, Joe, that I really liked about our conversations was when we looked at potentially adding additional policies for myself, what you looked at, what you basically said is basically you want to make the policies almost free for me. Like I'm going to evaluate your entire financial picture. We're going to see, can we pull a little bit from here and here where you're not adding an extra $5,000-$10,000 a year. What you're doing is you're maybe reallocating some of your additional resources. What is your strategy when it comes to that? And can you give an example? Let's say someone comes in and they're a high net worth individual.
Sure.
Where are the common places where you could usually find the savings for them so that they could maybe get a policy like this?
Absolutely. In many of the financial things that we do in life, there's inefficiencies. There's things that we do every day that erode capital, either by default or design. And money, we like to describe money where it should be in motion, like physics, where the financial institutions teach us the opposite, whereby they want an asset to be at rest, as we like to say, which is that you put money in a drawer and you leave it in that drawer for a period of 10, 20, or 30 years. But if you look at simple physics, the law of motion, that an object in motion continues in motion. So if money continues in that same line of motion, we then start to look at money a little bit differently and say, how can we have money work in coordination? If money works in coordination with other dollars, the output could be greater. So an example of that is, what is a client doing today that might not be the most efficient thing for what they're looking to accomplish? What are the positives and negatives of that financial decision? And is there something that they could be doing that's more optimized with those dollars that puts money back into their balance sheet, that gives them the ability to take advantage of the velocity of money? And I'll give you an example. Let's say a client comes in and they refinanced their house during the pandemic with low rates, and they took a 30-year mortgage at 3%. And they went on a calculator and realized that they could save a couple of $100,000 of interest by sending an extra $500 or $1,000 a month towards that mortgage payment. They are going to save money and interest if they prepay that mortgage payment. But we want the client to understand from more of a big picture what else is happening in that scenario. As an example, as they prepay that mortgage, they might be losing a valuable mortgage interest deduction that they have. As they prepay that mortgage, looking back in hindsight helps us make this decision a lot simpler now. They might have to refinance and get approval to take that money back out in the future, and that might have to be done at a higher interest rate. They might be prepaying that mortgage, and they might not have proper protection from death, from disability. They might not have adequate short-term savings. So we always want the client to be in a position where he has the maximum amount of leverage, liquidity, and control use of their dollars. And when we work with a client, we look at all of the different ways that dollars are sliding through their fingers, either inefficiently or ineffectively, and we look to take those dollars and have them get back onto the client's balance sheet so they could control it and not relinquish control to the financial institutions and the government.
Got it. And one thing, I guess, on this slide that you have up right now, you say that access to 95% of cash value. Typically speaking, on these type of policies, when do you usually see that kind of access? Is it in the first year, the second year, third year, just so people can have some kind of frame of reference?
So that really depends on how the policy is structured from the onset. There's ways that you can overfund policies. And I know you've learned about like the infinite banking concept, where you've got a lot of access to cash in year one. Most of the policies that we structure are not that way. We try to make it where our clients have a lot of access to the capital inside the policy after the second policy year. There are some policies that you don't have access to the cash value for the third or fourth policy year. So that really depends on how the policy is structured. And based on what the client is looking to accomplish, you could work with the client and customize a policy to get cash value where you need it to be at a certain period of time.
Got it. And you mentioned infinite banking concept. How is this approach different than the infinite bank concept?
The way I see infinite banking concept, which I don't think it's a bad tool. It's not something we actively practice in our company. And I think that is because the infinite banking concept puts an over concentration on the utilization of cash value inside of the insurance policies in the early years. My research has always shown that the infinite banking concepts look really well when you're looking at models of males or females at the age of 30 years old and maximizing cash value in the early years and death benefit later on. A lot of the folks that we work with in our practice happen to be a little bit older than that. And when you start looking at having less of a death benefit over the first 20 or 25 years of a policy, we want to make sure that the client has maximum death benefit and understands the value of the cash value inside of those policies so they can truly get the benefits of not only the internal returns of the policy, but the eternal and the external returns. So everything's working in financial coordination.
Got it. And how does this compare? I know there's been some new, I guess not new, but recently marketed policies. They call it like premium financing, where, instead of paying every single year, you pay a large sum, let's say $100,000, then you go to the bank, get a line of credit, and basically use the bank to pay the future years. How does this compare in terms of like cash value in 20, 30 years? What do you think of that strategy compared to something like this?
So premium finance is a very specific, also a very misunderstood concept and as a tool for financial planning. Premium finance could be a very powerful tool for the right scenario in financial planning. Premium finance could also be a very dangerous tool and is often misunderstood by the consumer, at points maybe even misrepresented by advisors. The concept behind premium finance is simply stated, it's the opposite of what we're talking about here. It's having a bank finance the premiums of the policy. And in our experience, the way that typically works best is when you have a high net worth individual that's expecting a liquidity event in a short time period of, let's say, less than 10 years, and their capital is better serviced in the asset that money is currently in, whether it be their business or whatnot. And it wouldn't make sense for them to put the resources towards an insurance policy. But again, they see the value of the long-term protection. So I would caution anybody who's buying a premium finance policy and then planning on utilizing the money inside the policy, it's counterintuitive. That's really not how those plans work.
Got it. Interesting. Why don't let me see. Hold on. I think we have a question. Hold on. Yeah, Justin, if you want, actually, hold on. If you want, just put it in the chat box and then I'll make sure Joe sees the question. While he's typing, we'll get into the next thing. One of the interesting things about these policies is banks will use these policies as collateral for line of credits. Do you usually recommend an individual who is going to be accessing that cash to do it directly through the policy, or set up a line of creded with the policy, with a line of credit with a local bank, and then access the funds that way?
So that's another question. Great question, Dennis. That's another question that is really specific to the client, what the client's looking to accomplish, and what the interest rate environment is. Okay. So I'll walk you through each of those scenarios. So if a client is very concerned about cash flow, okay, and can't use a monthly expense, it might not make sense to borrow from a third-party lender because a third-party lender might have a monthly interest expense. Where a lot of mutual insurance companies, if you're borrowing directly from the insurance company, will take the interest in advance from the cash value. Now, there might be a higher cost associated with that interest, but it would also eliminate a monthly cash flow crunch that might be important to the clients. So that's not what's good or bad. It's what works better for the client. I would say the most sensitive element around that question is around interest rate sensitivity. Pre-2022, third-party lenders had variable rates against collateralized policies in the low to mid twos as a variable rate. When a lot of our clients have fixed rate loans on some of their policies, and those rates are as high as 5 or 6%. Now, how quickly the tide has turned, but 2 years ago, a variable rate would have been a much better option if we were purely looking at that from an interest expense comparison. Now, a lot of these mutual insurance companies have fixed loan rates of 5% as an option. If you have a 5 or 6% loan rate on your policy, that could right now wind up being a lot better than a variable rate. So there's two big things. Number one, cash flow. Are we paying interest in advance, or are we paying it monthly? And number two, what's the difference in the interest rate, and what does that sensitivity actually mean?
Got it. And one thing I know from the infinite bank concept, they usually recommend something like if you have at least $10,000 a year to deploy. Is that the number you usually recommend as a minimum with your clients for a policy that really has a cash value focus? Or since you do it a little bit differently, you have different kind of recommendations?
So we never recommend to a client what a minimum amount that should go into these plans that makes it worth it. I will say that with our client base, we're very rarely writing life insurance policies for amounts less than that. They're usually substantially higher, and that's most likely because the clients that we're working with want to have high death benefits. They're a little older in age, and their premium contributions are going to be substantially more than $10,000 a year.
Okay. And is there a strategy that you could use for someone who wants to lock in these benefits, but maybe doesn't have $10,000 a year to allocate towards a policy like this?
Absolutely. And that goes back to the protection conversation. Irrespective of savings, we're big advocates of protection. And protection typically, Dennis, is better served when you're younger and healthier, right? So when we have clients that want to maximize their protection, but don't have the cash flow, which is very common, to be able to utilize that purely in a whole life insurance policy, there's different ways that you can structure, for example, term life insurance policies, which are purely for death benefit, but we can lock in insurability for periods of time and add things like conversion riders to those policies, whereby as a client begins to grow and as a client begins to develop and as a client begins to change his financial status, whether it be from cash flow or a liquidity event, we then can begin to convert some of those term policies without having to run the risk of insurability in the future.
Got it. And how do you view these policies in terms of a long-term estate planning perspective? I know you're a fan of the Rockefeller method, and as well as I am. Like, how do you view these policies? Is this something like you would recommend, something like where the family gets it on almost everybody in the family when as young as possible? Like, what do you view this in terms of as a piece to the overall puzzle that involves estate planning?
Listen, as every financial situation is different, everybody's financial circumstances are different. There's not a blanket recommendation, so to speak, but I will say that when you have a protection first philosophy, irrespective of one's net worth size, there's always a room in somebody's estate plan for a bucket of money that comes tax-free, that's very liquid, at the point of a triggering event, irrespective of what's going on in the outside world. And life insurance provides tremendous value for so many reasons as a death benefit. From an estate planning play, there's an income tax-free death benefit that gets paid to the beneficiaries within a very short period of time of death. That liquidity could be used to solve for estate equalization. It could be used for estate taxes. It could be used to maintain liquidity inside of an estate to unwind a business or help pay bills until assets are liquidated. So the advantages of permanent life insurance, specifically talking to the death benefit in the area and space of estate planning, in my opinion, is one of the most advantageous tools that exist within the estate planning space.
And Joseph, in terms of, I guess, real estate, I know we have different philosophies on how we approach real estate, but in my field, a lot of real estates are in partnerships and syndications. How does life insurance policies play a role in that, in terms of maybe certain language that investors should be looking for if they're looking at an operating agreement before investing, like a follow-up on that?
It's funny, Dennis, we spend a lot of time in the business succession planning space, where we're working with business owners to make sure that, no different than the personal balance sheet, that their business continues and has succession in the event that one of the principals aren't there. When we look at operating agreements for limited partnership or general partnership agreements or syndication agreements, one of the questions we always ask the business owners or the syndicators is, okay, you've got this wonderful deal where you're buying X amount of units in a different state and your investors are from all over the place. What happens if something happens to you? How does this plan succeed? What's the succession plan for this business structure? How do your investors get their money out if Dennis isn't here to operate that deal? And what we found is that, going back to that death benefit conversation, one of the things that are very helpful is providing a pool of capital to that partnership. whether it be to return distributions back to investors because of the premature death of a syndicator, or to just be able to bring somebody else in, whether it be a CEO or somebody to be able to take that business and unwind it to make sure that it meets the commitments that it made to its investors. So life insurance is very helpful in business succession planning, whether that be real estate syndication or a manufacturing plant that's creating widgets.
And how often do you see a business partnership or real estate partnership that doesn't have proper succession language in the operating agreement?
Unfortunately, it's more often than you would think. By virtue of creating entities, almost everybody has an operating agreement because it's part of the nature of what you need to open a bank account and the basic fundamentals of starting a corporation. And I can't tell you how many people we meet with that adamantly tell me they've got a proper operating agreement, and when we receive a copy of it and send it to an attorney for review, it's uncovered that it's the standard document that was created from the basics of the formation documents with nothing special in it at all.
Gotcha. So we're approaching the top of the hour. I don't see any questions. I did want to give a chance for you just to basically tell our listeners where they can learn more about you, your company, where you mainly operate out of.
Yeah, absolutely. And our main office is in Red Bank, New Jersey. We also have an office in New York City. The best way to find us is through our website. You can go to www.beyondfinancial.com. Through beyondfinancial.com, you can send us an email. Our phone numbers are on there. You can contact us, my staff, and somebody can certainly set up a time to speak if that's something that you have any questions on or would like to talk in a more intimate setting, one-on-one.
Joseph, I can't thank you enough for your time. I know you got to get going. You're still working late. Really appreciate your time. We definitely got to do a follow-up call, but it was great having you here. And thanks, Joe.
My pleasure, Dennis. Good luck.
All right, Joe. Have a great night.
You too. Bye-bye.